Let's dive into the fascinating history of futures trading. Imagine you're a farmer from a time long ago, worried about the unpredictable future of your crops and their prices. This is where the concept of futures trading began. The roots of futures trading can be traced back to the 17th century in Japan. During this period, Japan was a land of rich culture and tradition, with bustling marketplaces and thriving agricultural communities. Farmers growing rice wanted to secure a steady income, despite the unpredictable weather and market conditions. The life of a rice farmer was fraught with challenges, from typhoons to droughts, which could devastate their crops and livelihoods. They entered into agreements with merchants. These agreements were not just simple transactions. They were carefully negotiated deals that required trust and mutual benefit. These agreements stated that the farmers would sell a certain amount of rice at a set price in the future. This innovative approach allowed farmers to lock in prices and ensure a stable income, regardless of future market conditions. This way, both the farmers and merchants could plan better, without worrying about price fluctuations. It provided a sense of security and predictability in an otherwise volatile market. This practice evolved as people realized they could trade these agreements themselves, not just the rice. The agreements became valuable assets in their own right, leading to the development of a more sophisticated trading system. This was the birth of what we now call futures contracts. These early contracts laid the foundation for modern futures trading, influencing financial markets around the world. The ingenuity of these Japanese farmers and merchants has had a lasting impact, shaping the way we manage risk and trade commodities today. Fast forward to the 19th century, and the concept of futures trading made its way to the United States. This period was marked by rapid industrialization and urbanization, with cities like Chicago growing at an unprecedented rate. The need for a more organized and efficient way to trade agricultural products became increasingly apparent. Chicago became a bustling hub for trading agricultural products like grain. The city's strategic location near the Great Lakes and its extensive railroad network made it an ideal center for trade. Farmers and traders from all over the Midwest would bring their goods to Chicago, where they could be bought and sold in large quantities. Traders began to formalize these futures contracts at a central marketplace, known as the Chicago Board of Trade, which was established in 1848. This institution provided a standardized platform for trading, reducing the risks associated with price fluctuations and ensuring that both buyers and sellers could agree on fair terms. The establishment of the Chicago Board of Trade marked a significant milestone in the evolution of futures trading. While futures trading started with agricultural products, it began to diversify by the 1970s. The economic landscape was changing, and traders saw opportunities in other markets. This diversification was driven by the need to manage risks in various sectors, not just agriculture. This decade saw significant changes in the financial markets, including the breakdown of the Bretton Woods system, which had previously pegged currencies to the US dollar. The collapse of this system led to floating exchange rates, which introduced a new level of uncertainty and volatility in the global financial markets. This led to increased volatility in currency exchange rates, interest rates, and other financial metrics. Investors and businesses were suddenly exposed to greater risks, and there was a growing need for tools to manage these risks effectively. Futures contracts provided a way to hedge against these unpredictable changes, offering a form of financial security. Seeing this volatility, financial market participants began to use futures contracts to hedge or protect themselves against these unpredictable changes. This practice allowed them to lock in prices and rates, reducing the uncertainty and potential losses associated with market fluctuations. The use of futures contracts for hedging became a fundamental strategy in financial risk management. Thus, the concept of financial futures was born. These contracts were not limited to agricultural products, but extended to financial instruments like currencies, interest rates, and stock indices. The introduction of financial futures opened up new possibilities for traders and investors, allowing them to speculate on and hedge against a wide range of financial risks. New exchanges emerged, like the Chicago Mercantile Exchange, which pioneered trading in these financial products. The Chicago Mercantile Exchange became a leading platform for trading financial futures, attracting participants from around the world. Its success demonstrated the growing importance and acceptance of financial futures in the global market. Also, during this period, advances in technology and communication made it easier for more people to participate in the futures markets. The advent of computers and electronic trading systems revolutionized the way trades were executed, making the process faster and more efficient. These technological advancements lowered the barriers to entry, allowing a broader range of participants to engage in futures trading. Computers enabled faster processing of trades, and the reach of futures trading expanded globally. The interconnectedness of global markets meant that futures trading was no longer confined to specific regions or products. It became a truly global phenomenon, with exchanges and participants from all over the world contributing to the dynamic and ever-evolving landscape of futures trading. This global expansion brought new opportunities and challenges, shaping the future of financial markets in profound ways. So the history of futures trading began with farmers in Japan, looking to protect their rice prices from the unpredictable nature of weather and market demand. These early contracts allowed them to lock in prices and ensure a stable income, which was crucial for their livelihood. This concept of futures trading eventually grew into formalized markets in the United States. During the early 20th century, these markets provided a structured environment where traders could buy and sell contracts for various commodities, ranging from agricultural products to industrial goods. The practice further evolved in the 1970s with the introduction of financial futures. This innovation expanded the scope of futures trading beyond physical commodities to include financial instruments like currencies, interest rates, and stock indices. Today, futures trading has become a cornerstone of modern financial markets. It allows everyone from farmers to large corporations to manage risk and ensure more predictable outcomes to their business ventures. By locking in prices and hedging against potential losses, businesses can plan more effectively and allocate resources more efficiently. Understanding this history gives us a clearer picture of how integral futures trading has become in helping stabilize economies and helping traders and businesses navigate an unpredictable world. As we move forward, the principles of futures trading continue to evolve, adapting to new market conditions and technological advancements. This ongoing evolution ensures that futures trading remains a vital tool for economic stability and growth, benefiting a wide range of participants in the global market.